Fall, the IRS issued new IRC proposed regulations that could seriously impact the ability to generate valuation discounts for the transfer of family-owned entities. Joining us by phone is Kansas Farm Bureau Professor of Agricultural Law and Taxation at the Washburn University School of Law, Roger McOwen. Thanks so much for joining us, Roger. And if the proposed regulations do become finalized in their present form, how might this impact estate planning techniques?
Well, good morning, Christina. And it would be a big deal because those regulations really change the way the IRS is trying to value closely held entities and small businesses, which includes a lot of farms and ranches, of course. It would basically deny the ability to structure business operations so that minority interests could be discounted to reflect that minority position, as well as take away lack of marketability discounts because it's not publicly traded interests in these small businesses. But it doesn't look likely that they'll actually be finalized. They didn't get finalized before the new president took office, and they're under review right now. But there may be new regs that come, but I just don't think that they'll be in this final form.
Okay, now you mentioned the family limited partnership. How does that play a role here?
Well, that's a big deal because the principal objective of an FLP is to carry on a closely held business where management and control are important. And that's a big deal to a lot of farm and ranch operations. And they have significant tax and non-tax advantages. And you're able, again, to derive these very significant up to what I've seen 45, almost 50% discount from fair market value for the interest in those entities for both estate and gift tax purposes. So if that were taken away, that would be a major blow to a lot of farming operations that are counting on those discounts for business planning purposes.
Okay, let's talk about an alternative here to the FLP, restricted management. Can you talk a little bit about that?
Yeah, the restricted management account is just simply an investment account where the investor gives up control of certain assets to an investment manager for a certain period of time, and the manager exclusively manages the account assets. They haven't been utilized that heavily in ag, but for non-ag small businesses, the RMA, the restricted management account, is a viable alternative to get your discounts through that type of structure.
Okay, now I may be wrong here, but it seems like the real question at hand is, can a discount from fair market value be taken for the potential income tax liability to the beneficiaries of an IRA when the assets in the account are distributed to them?
Yeah, the short answer to that is no. And, of course, what we're trying to do is compare this with C corporations that have built-in tax. And there's a lot of ag land trapped in C corporations that were created back in the 1960s and 1970s and early 1980s that now farmers and ranchers want to get that land out of the C corp structure because it's not providing the tax advantage that they would like. But Congress changed the law in the mid-'80s and said you can't do that without a double tax effect. Well, what has developed over time is the ability to take a discount from value, the buyer can, for that tax that's trapped in the C Corp. Some have tried to say, well, you can do that with respect to an IRA. Short answer is you cannot do that. The IRA doesn't have a tax liability that the buyer would have to pay. It's the beneficiary that has that, so no discount with respect to IRA.
Excellent. Okay, thank you so much for helping us look out for ourselves, and now you're helping us look out for our families as well. Kansas Farm Bureau Professor of Agricultural Law and Taxation at the Washburn University School of Law, Roger McOwen. Always a joy to talk to you. We always learn something very valuable. And stay with us. Meteorologist Tim Ross has your forecast coming up 10 after the hour. We'll be right back.